All right, folks, we are going to take a break from our Q2 earnings coverage and we're going to take a look at our other backlog, which includes companies that are focused on major developments. The first target of this backlog is Marimaca Copper, who on Tuesday released a much awaited definitive feasibility study for their Marimaca Oxide Deposit in Antofagasta, Chile. The economics here look quite positive at a high level, so let's dive in. Marimaca Copper has officially released a definitive feasibility study for their flagship project. But before we get into the numbers, we should say that the company has gone about things a little bit differently here. The study itself outlines an operation that at the high point will be producing 50,000 tons of copper cathode a year. But really, the actual end goal appears to be much larger. A key aspect of the entire study is that the pricing included within is based on the purchase of oversized equipment and infrastructure. This would allow for cost-effective future production expansion. That oversized equipment includes the primary and secondary crusher, which would enable cost-effective expansion in year 6 of operations if Marimaca so chooses. Also included in the oversizing is the Ripios dump capacity, which is being made larger to allow for mine life extensions alongside water pipelines and infrastructure, power connections, and the footprint of the heap leach pad. So why is this? Well, Marimaca is approaching the entire project as a larger hub and spoke type deal, with this initial DFS serving as the hub of that arrangement. Specifically, Marimaca has said that the DFS is a starting point in their organic growth strategy, with growth opportunities including the inferred resources, which is treated as waste in the current plan, as well as Pampa Medina and Madrugador oxides, which provide the potential for the hub and spoke arrangement down the road, which doesn't include the sulfide exploration potential at both Marimaca and Pampa Medina. CEO Hayden Locke was quick to comment on the blue sky opportunity here, stating in the related news release, "We are well progressed on a PEA for Pampa Medina, which has been briefly paused due to recent drilling success. And we now see strong potential to increase our production target scale from the contemplated 50K tons per year of copper cathode production with oxides from the Pampa Medina and Madrugador deposits. We strongly believe 50,000 tons per year of copper production is a starting point for the company as we continue our journey towards being a significant global copper producer." Locke also added that they intend to push production beyond 70,000 tons per year within the next 5 years. In simple terms, there's lots of room for growth here, and the Marimaca Oxide Deposit is just the start. All right, let's get into some of the details here for the feasibility study. The study itself envisions an initial 13-year mine life for the project, with a 50,000 ton per annum copper cathode production target. But that target is just that, a target, and a nice round headline grabbing number. The reality, however, is that steady state production, which is from years 2 to 10, is expected to average 49,000 tons per annum of grade A LME copper cathode production. Most of that comes from the first 5 years of production, which is expected to average an actual 50,000 tons of production a year. Well, over the 13-year mine life, production is expected to average a lower 43,000 tons per year, meaning production falls off in the back half of the life of the mine, at least under the current parameters. Production here is to come from a single open pit, after which 3 stages of crushing will be utilized, alongside agglomeration and dynamic heap leaching. The pit itself is to be developed over 8 separate phases, which drives an incredibly low strip ratio of 0.8 to 1, which includes initial pre-stripping and also assumes that the inferred material is waste. Initial throughput is assumed at 12 million tons per annum, which bumps up to 16 million tons per annum in year 6 of the mine plan. That bump in processing is basically a result of reduced grades. The first 5 years of steady state production are expected to see average head grades of 0.52% copper, driving annual recoveries that average 77%. But over the life of mine, head grades are expected to average a lower 0.42% copper, while recoveries are expected to average 72%, meaning again the back half of the life of mine won't be as rosy. But that isn't exactly uncommon in the mining world, where the initial focus is paying off initial capital more than anything else. And on that note, let's examine the numbers. Initial capital here is estimated at 587 million US dollars. Expansion capital, which is expected again to come in around year 6, is estimated at 77, while sustaining capital over the life of mine is pegged at 529. And then there's also closure costs of 47 million. We're told that those estimates should be fairly accurate, with budget quotations obtained for about 80% of the equipment needed. Contingencies of 10% have been factored into the estimate as well. We should also note that the water and power infrastructure have been included on the basis of build, own, operate, transfer proposals that have been provided by local and internal firms in Chile, which will drastically reduce upfront capital costs while moving this costing to operating costs. The result is that Marimaca now sits amongst the lowest absolute capital costs and capital intensities for greenfield copper projects globally, at least based on Wood Mackenzie estimates. On a per-pound basis, Marimaca has, of course, broken up cost estimates into two main categories to really sell this to investors. We've got the first 5 years of steady-state production and the life of mine in terms of cost buckets. There's also a first 10 years category, but considering this is a mine life of 13 years we're working with, we're going to ignore that entirely. Anyways, over the first 5 years of steady-state production, C1 cash costs are estimated at $1.45 per pound of copper produced. All-in sustaining costs are meanwhile estimated at $1.97 a pound. Over the life of mine, C1 cash costs rise to $1.84 a pound, while all-in sustaining costs rise to $2.29 a pound. So how does this shake out altogether? Based on a copper price of $4.30 per pound, the Marimaca Oxide Deposit is estimated to contain a net present value of $709 million and an internal rate of return of 31%, with a payback period of 2.5 years using an 8% discount rate on a post-tax basis. At the trailing 3-month COMEX copper price of $5.05 a pound, the net present value of MOD is said to rise to $1.1 billion, while the IRR climbs to 39%. But if we're being honest here, copper, as of the time of writing, was trading at $4.53 a pound. So that last set of figures isn't all that relevant. So what are the next steps here? Well, Marimaca is already working on that. Project permitting is said to be well underway, with environmental approvals expected to be received before year's end. Some sectoral permits are needed to be obtained after environmental approvals come in before full construction can get underway. But a provided timeline suggests construction will get underway officially in a year's time. In the interim, detailed design and engineering is already starting, along with further metallurgical work, grade control drilling, and deposits on key equipment are set to be made. Early work site prep is also expected to begin shortly, which includes the construction of access roads and buildings. Funding for the next steps is said to come from the $24 million in cash on hand, which Marimaca says is sufficient. But debt financing discussions have already begun as well, with an initial outreach program securing expressions of interest of up to $500 million for the project, which was based on initial pre-DFS financial models prepared by the company. Several large shareholders are also invested in Marimaca, including Mitsubishi Corp and Assur International, suggesting funding can also come from the equity side of things. Strategic alternatives are also being explored for the development of the project, with those discussions including engagement with strategic mining companies and copper producers, as well as traders and off-takers and other alternative financing sources. All right, so let's wrap it up. If there ever was a project that looked like it was going to be advanced, this is it. In the interest of time, there's lots of stuff we left out here, like how the water is to be sourced from recycled seawater, or how there's no community land overlap. And then we got the fact that this project is in a desert, so there's little flora and fauna impact. We've also got that the land here is predominantly government owned and controlled, making things much easier from a development perspective. There's also the fact that Marimaca has entered into an option agreement to acquire a 150,000 ton per year sulfuric acid plant, which wasn't included in the DFS as a result of the timing. The plant represents up to 40% of all sulfuric acid needed by Marimaca, and will also result in up to a 30% reduction in acid costs for leaching. All told, Marimaca is on the right track from what we can tell. And with an overly aggressive development timeline, we could be looking at a new copper producer hitting the market well before the end of the current decade. All right, everybody, thanks for watching. If there's stories you want us to cover, as always, let us know in the comment section. Also, if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.